Hi there. In this video, we'll explain that if your income exceeds £260,000, your pension allowance could be reduced significantly.
Right, let's get straight into it. Welcome to this explainer brought to you by My Tax Accountant, your trusted UK accounting firm helping you navigate the, quite frankly, very complicated world of tax compliance. Today, we're zooming in on a massive hidden tax trap for the 2026/27 tax year. We're talking about the Tapered Annual Allowance, specifically how earnings above £260,000 can absolutely slash your pension limit in the UK. Listen, if you're a high-earning professional or a company director, the tax system has this built-in mechanism that's basically designed to quietly chip away at your pension tax relief. And honestly, it catches so many people out. Let's look at exactly how it works.
50 grand. £50,000. That is the staggering amount of tax-free pension allowance you could literally lose this tax year if your earnings triggered this taper. I mean, imagine thinking you've got your standard £60,000 allowance sitting there, ready to shelter your hard-earned wealth, only to get a nasty shock from HMRC telling you your limit has been slashed down to just £10,000. That leaves you facing a hefty 45% tax charge on the difference. It's brutal. So we really need to get ahead of this before the tax year wraps up.
Okay, so here is our quick roadmap for today's explainer. We'll start with the taper shock itself, break down threshold versus adjusted income, run through the actual calculations, look at a real-life scenario, discuss how to protect your allowance, and then wrap up with how we can help.
Right then, part 1, the tapered allowance shock.
So, the standard annual allowance, which is the amount you can pop into your pension tax-free every single year, is currently a very generous £60,000. But, the government isn't just going to give unlimited tax relief to top earners paying higher and additional tax rates. The taper is essentially this relentless financial mechanism that mathematically chops your $60,000 standard allowance down all the way to an absolute floor of just $10,000 as your income goes up. And this directly targets folks with complex income. We're talking a mix of salary, bonuses, dividends, and, this is the big one, generous employer pension contributions. It's an incredibly stringent policy for the 26-27 tax year, and it catches so many high earners completely unawares.
Moving on to part 2, we need to talk about threshold versus adjusted income.
To figure out if you're caught in this trap, HMRC uses 2 tests. The first test looks at your threshold income. I actually like to think of this as the gatekeeper. Threshold income is broadly all your taxable income. So your salary, dividends, property income from your buy-to-lets, interest, the whole shebang, minus any personal pension contributions that you make yourself. The magic safe haven number here is £200,000. If your threshold income is £200,000 or less, you can breathe a sigh of relief. You're entirely safe. The taper doesn't apply and you keep your full $60,000 allowance. Knowing this gives you immense peace of mind. But if you breach that $200,000 gatekeeper, well, you're forced into test number 2.
And test number 2 is your adjusted income. This is the true trigger point where your standard allowance actually starts to shrink. To find your adjusted income, you take your taxable income, but then, and this is the sneaky part, you must add back all the employer pension contributions made on your behalf. Yes, that includes anything done through a salary sacrifice arrangement. The tapering limit here is £260,000. The second your adjusted income pushes past $260K, your tax-free allowance instantly begins to drop. This is exactly where so many directors mistakenly think they're safe because they completely forget to factor in the hidden value of those employer contributions.
Putting these 2 side by side really highlights the danger zone. Threshold excludes your employer contributions, but adjusted forces you to chuck them back in. This is the hidden trap. You might look at your take-home pay and think, brilliant, I'm well under the $260K mark. But the moment your accountant factors in that, say, £40,000 pension contribution your limited company made for you, your adjusted income suddenly spikes and bam, you are instantly caught in the taper. It's a really harsh reality of the current tax system, and it means you've got to be constantly vigilant. Okay, section 3, calculating your reduction. Let's see how the maths actually works. The calculation itself is completely mechanical. There's no gray area here. It's a strict 3-step test. Step 1. Did your threshold income cross £200,000? If yes, you move to step 2. Did your adjusted income cross $260,000? If the answer is yes again, the taper is officially activated. And step 3 is where the punishment kicks in. For every £2 of adjusted income you have over that $260,000 limit, you lose exactly £1 of your pension allowance. The formula leaves absolutely no room for negotiation or error. Every single quid matters when you're hovering around these limits.
Let's look at how brutal that linear reduction is in practice. If your adjusted income is spot on £260,000, your reduction is zero. You keep your lovely £60,000 allowance. But what happens when your adjusted income hits £300,000? Well, that's £40,000 over the limit, right? Losing £1 for every £2 over means you lose £20,000 of your allowance. Just like that, you're left with a £40,000 limit. And if your adjusted income climbs to £360,000 or beyond, you lose the maximum £50,000, leaving you with the absolute minimum floor allowance of just £10,000. It effectively wipes out your ability to aggressively save for your retirement in that year.
As you can see from the HMRC documentation confirming these figures, the rules are set in stone. The standard £60,000 allowance and the $260K adjusted threshold are rigidly enforced. There's no flexibility in these bands whatsoever, and HMRC expects you to get this maths exactly right on your self-assessment. This is statutory law, and frankly, saying "I didn't understand the rules" is simply not an acceptable defense if you over-contribute and get hit with a tax charge.
Part 4. Let's look at some real-life UK scenarios to make this concrete.
Meet Georgina. She's a UK company director taking a £230,000 salary. Her company also pays a very generous £50,000 employer contribution straight into her pension. Let's run her numbers through the tests. First up, her threshold income is £230,000. Because that is over the £200,000 gatekeeper, she fails the safe haven test. Next, we calculate her adjusted income by taking her salary and adding that employer contribution. £230,000 plus £50,000 equals £280,000. Okay, so she has breached the $260K limit by exactly £20,000. Because she loses £1 for every £2 over the limit, her allowance is mechanically reduced by £10,000. This means Georgina's allowance for the year isn't £60,000 anymore. It's down to £50,000. And since her employer already put in £50,000, she has exactly maxed out her new limit. If she pays a single penny more into her pension this year, she's going to face an immediate tax charge.
But wait, before you panic, here is a fantastic piece of good news. Did you know you can still use the carry forward rules? Yep, even if you're heavily tapered this year, HMRC allows you to look back at the previous 3 tax years. If you didn't use up all your allowance in those past years, you can carry that unused room forward into the current year to mop up a taper charge. It's an absolute lifeline. I mean, it can literally save high earners from an immediate 45% tax bill.
Section 5. Protecting your allowance. Let's talk strategy.
First things first, you have to meticulously monitor all your composite income streams. We aren't just talking about your main PAYE salary here. Rental income, dividends from your company, even a bump in interest on your savings. It all adds up and can push you over the edge. Second, and actually this is a brilliant strategy, you can make personal pension contributions from your after-tax income. Because threshold income is calculated after deducting your personal contributions, making a large personal contribution can actually drag your threshold income back down below that £200,000 gatekeeper. Do that and you rescue your entire £60K allowance. But listen, the maths here is incredibly delicate, which is why seeking professional tax planning is an absolute must to avoid a nasty shock when January rolls around.
Here is a pro tip that really puts things into perspective. Adding just £2 of unexpected dividend or rental income above that $260,000 adjusted mark costs you £1 of pension allowance. Think about that. The taper is completely relentless. If you're a landlord or shareholder, trying to DIY your self-assessment with these rules in play is just playing with fire. The margins are way too thin. One seemingly harmless dividend payout right at the end of the year could trigger a whole cascade of tax liabilities.
Finally, Section 6. Next steps with MTA.
I want to leave you with a slightly provocative question. Are you absolutely certain your complex income isn't triggering a hidden HMRC tax charge right now? If you've got a high salary, a decent bonus structure, dividends, and a healthy company pension scheme, the mathematical odds are that the taper is lurking somewhere in the background of your finances. You really need certainty to confidently manage your wealth.
And honestly, certainty is exactly what My Tax Accountant provides. We can run all these complex threshold and adjusted income calculations for you, perfectly sequence your employer and personal contributions, and look to see if you have those carry-forward allowances available to protect your wealth. So give our team a call at 0208-570-8531, or drop us an email at info@mytaxaccountant.co.uk, or just visit us on the web at www.mytaxaccountant.co.uk. Please note, this explainer is strictly for educational purposes and does not constitute financial advice, as tax rules are, of course, subject to change. Thank you so much for joining me today, and make sure to subscribe to the MTA YouTube channel for more structured, clear, and essential tax guidance. See you next time.